is already happening. It's been happening since last spring. $9 trillion on the balance sheet, maybe, 5-6 trillion today. It's a lot of money. But the notional value of derivatives off balance sheet of the banks is $1 quadrillion. And for listeners who might not have heard the word quadrillion before, 1 quadrillion is 1,000 trillion.
It's 32 zeros or something like that?
I've lost count, but it's a quadrillion is 1,000 trillion. So your 9 trillion at the Fed doesn't get you very far if you have to support 1,000 trillion dollars worth of derivatives. Mostly the banks doing off-balance sheet swaps and swaptions and other futures and forwards, and we don't have to go down the whole litany of names, with either each other because they're trading firms, or with hedge funds who want them for speculation or hedging, or sovereign wealth funds or other institutions. There's a whole network of participants. But these are the big boys. These are the trillion-dollar institutions, the BlackRock and the Temasek and the Sovereign Wealth Fund of Norway. These are the big players involved in this market. How is that supported? Well, it's supported with collateral. Not 100%, not even close, but maybe 1%, 2%. You got to put up some margin money to be in the game, but then you can have a lot more off balance sheet. So what's the best form of collateral? Well, it depends. Whether you're in a liquidity crisis or not, whether people are feeling confident or are worried, whether they think things are going to go great or start to collapse. So as things get more difficult, and that's the phase we're in right now, the quality of the collateral has to go up. So the banks are now saying to each other, I don't want your mortgages. I don't want your stupid corporate bonds. I don't even want 10-year treasury notes. Get me bills, treasury bills. These are short-term, very liquid, 1-year maturity or less. A lot of them are 4-week bills, 8-week bills, 6-month bills. These are very short-term, very liquid. They are the best collateral there is. And the banks are saying to each other, that's what I want. Okay, so now you're Barclays Bank or Deutsche Bank or UniCredit, Credit Suisse or bank, some major Japanese bank, etc. Where are you going to get the bills? Well, you got to buy them from a dealer, or you can buy them at auction. The Treasury has auctions, or you can get them from the Fed. But to buy a dollar-denominated Treasury bill, you need dollars. So that's why the dollar is so strong. Everyone's like, hey, Jim, we got these huge budget deficits and $1 trillion of expenses and bailouts and handouts and 131% debt to GDP ratio, $31 trillion in debt, et cetera. How can the dollar be so strong? Well, the answer is, it has nothing to do with everything I just said. The dollar is strong because everybody in the world needs dollars to buy treasury bills, to prop up the balance sheets of the 1 quadrillion of derivatives that nobody can see. And this is real. This is way behind the curtain, Kim. This is real inside baseball in terms of how the international monetary system actually works. So the strength of the dollar, which by the way is a headwind for gold, the euro's down, sterling's down, Swiss francs are down. Gold hasn't actually gone down a lot. It hasn't gone up a lot, but it's holding its own. But a strong dollar means anything denominated in dollars is going to go down, because if the dollar gets stronger, the dollar price of the commodity gets lower, or at least doesn't go up a lot. I spoke to someone recently. I said, well, Jim, I hear you. When's all this coming to a head? And I said, maybe this winter or this spring, sooner than you think. And I based that on the last 2 super liquidity crises when the world almost completely collapsed, or maybe it did, were 1998, that was long-term capital management Russia, and 2008 during Lehman Brothers. But I remind people, Sunday, September 15, 2008, Lehman Brothers filed for bankruptcy electronically on a Sunday night. And that was like, we all know what happened next. But that crisis started in 2007. Remember August 9th, 2007, Jim Cramer and Aaron Burnett on CNBC, and he's yelling, they know nothing, they know Well, he was right. They didn't know anything. They were idiots, meaning the Fed. And then Hank Paulson and the Super Civ and the Sovereign Wealth Fund bailout, and then Bear Stearns, Fannie Mae, Freddie Mac, and so there was a lot leading up to the Lehman Brothers, but it took a year. It took a year to go around. Same thing with long-term capital. It came to a head in September 1998. We were hours away from shutting every financial market in the world. We got the $4 billion in, stabilized the balance sheet, and life went on. But it was a really close call. But that started in June 1997. When Thailand broke the peg to the dollar, started to run on the bank in Thailand. It spread to Malaysia, Indonesia, South Korea. You always hear the expression, the time to buy is when there's blood in the streets. Well, sadly, there was blood in the streets, real blood in Korea, because people got killed. And then it went to Russia, then long-term capital. But my point is, everyone knows the acute stage, September 98 or September 2008, but it began a year earlier. So now everything we've just been talking about is already happening. It's been happening since last spring. So if you stick to this 1 year rule, and it's not a hard and fast scientific rule, but we've seen 2 cases where it took a year to come around. If that's your rule, and it started in March 2022, and there's good evidence for that, then kind of March 2023 is your D-Day. So right now, the Treasury, U.S. Treasury yield curve, you can look this up, I mean, it's not secret data. The yield to maturity on a 1-year bill is it's higher than a 10-year Treasury note. That's called yield curve. Why should that be true? Like if I'm going to lend you money for a year, okay, you might want a certain interest rate, but if I'm going to lend you money for 10 years, I want a higher interest rate because there's more risk, inflation, credit risk, etc. So why is the yield on the 10-year note lower than the 1-year bill? It makes no sense, except unless you think something bad is going to happen. If you think we're going to go into a really bad recession in a couple of months, which is what I was just talking about, then that yield on the 10-year note is going to look really good. You're going to have huge capital gains when that actually collapses. The Fed can't control the very short end of the yield curve. They cannot control 5-year notes, 10-year notes, let alone 30-year bonds. So the Treasury yield curve is telling you, it's like right there in your face, it's telling you that something bad is going to happen. Otherwise, those long maturity yields would not be lower unless you think something bad is going to happen.
So what does a liquidity crisis look like to mom and pop?
It looks like can't get a loan, interest rates on credit cards go up, interest rates on mortgages go up, at least initially. But where it really comes home is that, okay, that's the initial stage. A lot of people don't understand that interest rates peak after the recession begins. It's a lagging indicator, because as you go into the recession, people are like, hey, I don't want to lay people off. My revenues are going down. I'll borrow the money. It'll be fine. And then that causes interest rates to go up. But then when when it really hits you, it just slams you. You're like, okay, I got to fire everybody, and you're lucky you don't go out of business and you default on the loan. So interest rates are a lagging indicator. Unemployment is a lagging indicator because people, they really don't want to lay people off. They will if they have to, but that's like the last thing you do after you've cut out a lot of other stuff. So you can't, so people look at unemployment's low and interest rates are high, everything's good. No, these are the things that turn around after the recession.
So one of the first things that Biden did was cut off the Keystone XL pipeline.
Right.
And again, I went to the U.S. Merchant Marine Academy. I'm an oil tanker driver. When I saw that, I said, he's going to sink the middle class. Mm-hmm. And I'm not really religious, but I remember from Sunday school, they said the poor will always be amongst us. Mm-hmm. But when I saw Biden cut off the Keystone XL pipeline, he screwed the middle class. He just wiped them out.
Right.
And the middle class got wiped out. I got rich, Kim and I got richer because we were selling real oil at $30 a barrel, and oil went to $130 the next day. But mom and pop, this is the microeconomics, mom and pop are standing next to their Lincoln SUV, filling up the gas pump going, how come it was $50 last week, it's $100 this week? So in my opinion, when Biden cut off the Keystone XL pipeline, he basically took out the middle class. How does that fit with your logic?
It fits perfectly, and I agree with that. But then I always ask, well, okay, if the middle class lost, and they did, who's the big winner? The biggest winner of cutting out the Keystone pipeline was Warren Buffett, because a couple of years earlier, he bought the Burlington Northern Railroad. And what people don't understand, the oil from Alberta is still coming in. It's just, instead of coming through a pipeline, which is kind of clean and inexpensive.
Which is supply chain, pipelines is supply chain.
But it's coming in by train. Right. So oil tanker cars. So you line up 100 oil tanker cars in one train. It's a pipeline on wheels.
That's why they did that?
Well, that's why Warren Buffett did it. He could see it coming. Yes. So Warren Buffett owns the railroad. They're bringing in the oil from Alberta. They always have. They're bringing it on Warren Buffett's railroad, not somebody else's Keystone pipeline. So yeah, the middle class gets screwed. That was always part of the plan. And by the way, this is by design. Stupidity is not a sufficient explanation because it's actually working very well. You have to say this is what's intended, and they are screwing the middle class. But I also make the point that An economic recession or depression and a financial crisis are two different things. You can have one without the other, and we have, but they can come together. 2008, they came together, and I think they're coming together again in 2023.